You are welcome to the preparation of control account of receivables and payables. A control account of receivables and payables are accounts that contains or shows the summary or total of entries in the individual accounts of receivables and payables. When we talk about receivables, we refer to debtors, those people that our business sold goods to on credit. That means no cash or check was used during the transaction. Also, when we refer to payables, we refer to creditors, those people that we purchase goods from on credit. When we sell goods to customers and they don't pay, we refer to them as receivables or trade receivables. And when we purchase goods from suppliers without paying them, we refer to them as trade payables. Now, in an organization, there may be many receivables and many payables. How do we keep these accounts so that it does not create confusion? When we talk about receivables, we refer to debtors. That is, those people that we sold goods to on credit. When we sell goods to customers and no cash was received, we refer to them as trade receivable. On the other hand, when we refer to payables, we are talking about suppliers that supplied us goods without being paid. And such people are referred to as payables. In some organizations, there may exist hundreds, if not thousands, of such receivables and payables. And in order not to create problem in the preparation of accounting records in relation to receivables and payables, a control account is used to summarize or bring together all transactions that relates to payables and receivables. In our preparation of the control account of receivables and payables, we are going to approach them one after the other. Firstly, we are going to be looking at control account of receivables with references to individual control account of receivables. So we are looking at control accounts of receivables. When there is sales, and this sales is made to customers on credit, these customers are referred to as trade receivables. On the other hand, when we purchase goods from suppliers on credit, the suppliers are referred to as trade payables. Another name for trade receivables is debtors, while another name for trade payables is creditors. In the preparation of the control account of receivables, certain things has to be taken into consideration. Firstly, we should understand that receivables represents assets and has debit balance. Therefore, at the beginning of the period, if there is any amount that receivables are owing, it should be brought forward to the control account of receivables and debited. And we debit alongside any transaction that will increase the amount receivables are owing, and credit any transaction that will reduce or decrease the amount receivables are owing. Such transactions that will increase the amount receivables are owing include things like sales on credit, and such transactions that will reduce or decrease the amount receivables are owing includes transactions such as cash receipt, check receipt, discount allowed, and so on. For instance, if goods are sold to receivables on credit for $1,000, it should be debited. And if we receive cash of $500 from receivables, it should be credited, because cash received reduces the amount that receivables are owing. If there is discount allowed, it should be credited to the receivables control account, because it reduces the amount receivables are owing. If there is any check received or bad debt written off, it should be credited to the receivables control account, because it reduces or decreases the amount that receivables are owing. So by debiting the amount receivables are owing and crediting what receivables has paid directly or indirectly, then we can now ascertain the balance of the receivable at the end of the accounting period. We are going to take some illustrations or examples using three accounts: Bennett's account, Joe's account, and Ben's account. These people or persons represent individual receivables of an organization. With this illustration, you will have a better understanding of what the control account of receivables is all about. The receivable account we are going to use as illustration for individual receivables account will be Bennett's account, Joe account, and Ben account. Let's look at Bennett's account. Remember, we said that any transaction that will increase the amount receivables are owing will be debited, since assets are debit account and receivable account represents an asset account. The balance brought down of 3,000 here represents the previous balance that Bennett is owing our organization, and now brought down in Bennett's account, an indication that Bennett is owing us $3,000 previously. Now, another thing that can increase the amount that Bennett is owing us is sales. When we talk about sales, we are referring to credit sales, not cash sales. The credit sales made to Bennett is $20,000, bringing the total amount that Bennett is owing us for the accounting period to $23,000. That is 3,000 plus 20,000. Now, as the rules implies, transactions that will reduce the amount that Bennett is owing us will be credited, since the debit side represents addition of what Bennett is owing, and the credit side represents subtraction of what Bennett has paid directly or indirectly. The transactions that will reduce the amount that Bennett is owing will be credited, and this includes, among others, cash received $13,000, check received $500, discount allowed $100, bad debt written off $7. When cash is received from Bennett, that is receivable, of $13,000, it reduces the total of $23,000 that Bennett is owing. Of course, we receive from receivables because they are owing us. The amount received from Bennett is $13,000. When check is received from receivables, it reduces the amount they are owing. When check is received from Bennett or receivable of $500, it reduces the amount that Bennett is owing. Also, when discount is allowed receivables that can no longer be recovered, such amount is written off and credited to the receivables control account, and it decreases the amount that receivables are owing. Of course, these are some of the transactions that reduces the amount that receivables are owing. For the sake of our foundation knowledge, since we are still at the preliminary stage, we are going to limit our operations with the use of these 4 transactions that reduces the amount receivables are owing. Also, some of these transactions that reduces the amount receivables are owing can also be reversed. For instance, when the check previously received or part of the check previously received have been dishonored, such check will go back to the debit side of the receivables control account. When bad debt written off is recovered, it goes back to the debit side of the receivable control account. It should be noted that all of these transactions that reduces the amount receivables are owing can also be reversed. For instance, if check previously received from Bennett has been dishonored, it will be reversed and debited to the account again. There could also be interest charged on customers for transactions carried out on their behalf. This will also be debited in the receivables control account and will increase the amount they are owing. As we can see, there was interest charged to Bennett of 400, and this has increased the amount Bennett is owing. Part of the checks received from Bennett of $500 can also be dishonored by the bank. If this occurs, part of such check dishonored or all of the checks dishonored will also be debited. As you can see, we have $100 as dishonored check, representing part of the check of $500 that has been dishonored. There are also other transactions that could be debited to the receivables control account. And there are also other transactions that could be credited to the receivables control account. But the simple rule is that we debit the amount receivables are owing and debit alongside any transaction that increases the amount they are owing. And on the other hand, we credit every transaction that will reduce the amount that receivables are owing directly or indirectly. At the end of the day, we make a balance of the debit side and the credit side to determine the amount that individual receivable is owing at the end of the accounting period. Let's look at Joe account and Ben account. Now, if we add the total amount that Bennett, a receivable, is owing, we have 3,000 plus 20,000 plus 400 plus 100. That gives us 23,500. Then if you deduct the amount that Bennett paid or the amount we received from Bennett directly or indirectly, which reduces what Bennett is owing, Then we have 23,500 minus 13,000 minus 500 minus 100 minus 7. That gives us a closing balance. So we have a balance carried down of 9,893. If you add 9,893 plus 7 plus 100 plus 500 plus 13,000, it will give us the same figure as 23,500, which we are going to place here in the same line with this. That gives us 23,500, which is in the same line with this, and the account is closed. Then for the next period, this 9,893 is taken back to the debit side under the closed figure of 23,500, and it becomes balance brought down. That is $9,893, the same as the balance carried out, which is the closing balance of receivables, and this becomes the opening balance of receivables at the beginning of the new period. Now the same is applicable to Joe's account and Ben's account. Now the balance brought down in Joe's account at the beginning was $2,000. Remember we said that any transaction that will increase the amount that receivables are owing should be debited. Applying this principle, we debited credit sales of 15,000 made to Joe. Also interest charge of 300 on Joe's account. And also dishonor check of $80 on Joe's account. Then we have cash received from Joe, 8,000 credited, check received 400 credited, discount allowed to Joe, $80 credited, and bad debt written off of $5 credited to Joe's account. These transactions reduces what Joe is owing. The interest charge on Joe's account is 300, while dishonor check is 80. Now, calculating the total amount on the debit side representing what Joe is owing directly or indirectly, we have 2,000 plus 15,000 plus 300 plus 80. That gives us $17,350. Then we less all the transactions that reduced or decreased the amount Joe, a receivable, is owing. So if you have 17,350 minus 8,000 minus 400 minus 80 minus 5, is going to give us a balance carried down of 8,895. If you add 8,895 plus 5 plus 80 plus 400 plus 8,000, it gives us 17,380, which is now closed in the same line with this 17,380. Finally, the balance carried down of 8,895 is taken back to the debit side and becomes the opening balance for the next period, which is balance brought down of 8,895. So this is the net amount that Joe is owing as a receivable at the end of the accounting period. Just as this is the net amount or net balance that Bennett is owing at the end of the period. Considering Ben's account, we have opening balance that Ben is owing as 1,000. Of course, other items that increase the amount Ben is owing is sales made to Ben. Of course, credit sales of 10,000. Bringing what Ben is owing to 10,000 plus 1,000, which is 11,000. There was cash received from Ben, 5,000. Check received, 300, discount allowed 50, bad debt written off 4, and there was a reversal of dishonored check of 50. That means part of the check of 300 was dishonored, $50. There was also an interest charge on Ben's account of 200, which increased the amount Ben is owing. Now, adding what Ben is owing directly or indirectly, we have 1,000 plus 10,000 plus 200 plus 50. That gives us 11,250 minus 5,000 minus 300 minus 50 minus 4. We now have a closing balance on Ben's account, a receivable of 5,896. If you add 5,896 plus 4 plus 50 plus 300 plus 5,000, it's going to give you 11,250, which is the same with the close figure here. Then the balance carried down, of course, of 5,896 is brought back to the debit side as opening balance or balance brought down for the new period, representing the net amount that Ben, a receivable, is owing at the beginning of the new accounting period. We have looked at 3 accounts of receivables: Bennett, Joe, and Ben. Assume that an organization has 500 of these receivables. There will be a lot of accounts in the company's book representing receivables. Of course, each receivable will have an account open on their behalf, showing that they are owing the organization. In large organizations where receivables accounts are numerous, it will lead to a lot of problems. Errors and frauds could result because most of these books may be kept by junior staffs or officers. It is for this reason that a total receivable control account is usually prepared to give a summary or total of all the receivable in just one account. However, before this total receivable control account can be prepared, an analysis will be made in form of a table to be able to ascertain or find out the total sales, the total cash received, the total check received, the total check dishonored, the total interest charge, the total bad debt written off, and so on. It is when these summaries are put into a table that it becomes possible for a total receivable control account to be prepared. We are now going to see how these individual receivables accounts will be transferred to a table, and then a total receivable control account, which is what organizations usually require, will now be drafted. So we have the table, we have name, balance brought down, sales, cash received, check received, interest charged, discount allowed, dishonored check, and bad debt written off. Now these names and the transactions forms the heading, and we have 3 receivables: Bennett, Joe, and Ben. Let's see how we have transferred these accounts into this table. For the Bennett account, the name is written there, Bennett, and all transactions that relate to Bennett has been written in the horizontal line. We have balance brought down 3,000 in respect of Bennett. You can see it's balance brought down 3,000. Then we have the sales 20,000. That is the 20,000 sales here, transferred to the table. Then we have cash received from Bennett, which is 13,000. You can see it here, cash received 13,000. Then we have check received 500. You can see check received 500. We have interest charge 400, and it's transferred under interest charge line 400 for Bennett. Then we have discount allowed, which is 100. Taken to the discount allowed, you can see it's 100. Then we have dishonor check 100. So the dishonor check for Bennett is 100. Then we have the bad debt written off 7. You can see it here, bad debt written off 7 for Bennett. So Bennett transactions occupies this line. Now let's look at Joe transactions. Looking at Joe, we have the Joe account. We have the balance brought down 2,000. You can see it under Joe 2,000. That is balance brought down controlling this line. We have sales 15,000. You can see it, sales 15,000 for Joe. Then we have cash received 8,000. You can see cash received 8,000 for Joe. Then we have check received 400. You can see check received 400 for Joe. Then we have interest charge 300. You can see it's interest charge for Joe 300. Then we have discount allowed 80 for Joe. You can see discount allowed 80 for Joe. Then we have dishonored check also 80 for Joe. You can see it under dishonored check, we have 80 for Joe. We have bad debt written off $5 for Joe. Looking at Ben's account, we have Ben in the table. The balance brought down for Ben is $1,000. So you can see it here, balance brought down for Ben is 1,000. You can see it under the balance brought down of 1,000. We have sales for Ben 10,000. You can see it under sales, Ben has 10,000. Then we have cash received 5,000. The cash received column 5,000. We have check received 300. You can see taken under check received column for Ben 300. We also have the interest charge 200 for Ben. You can see taken under interest charge column 200 for Ben. Then we have discount allowed 50 for Ben. You can see the under discount allowed column 50 for Ben. We also have dishonored check 50 for Ben. We have 50 under dishonored check for Ben. Then we also have bad debt written off $4 for Ben, transferred under bad debt written off $4 for Ben. So what we have actually done now is that the whole balance brought down representing the account of the 3 receivables are now in one line. The total balance brought down, if you add up, we have 3,000 plus 2,000 plus 1,000, which is 6,000. This 6,000 is representing the total of the opening balance of all the receivables for the period. If you add up the sales to Bernard is 20,000 on credit, sales to Joe is 15,000 on credit, and sales to Ben is 10,000 on credit. If you add 20,000 plus 15,000 plus 10,000, it gives us a total of 45,000, being the total sales made on credit to the 3 receivables. Under cash received from receivables, we have for Ben 13,000, we have for Bennett 13,000, for Joe 8,000, and for Ben 5,000. So the total cash received from all the receivables gives $26,000. Then check received from receivables, we have 500 for Bennett, 400 for Joe, and 300 for Ben. That gives us a total of $1,200. Then interest charge on receivables, we have 400 for Bennett, 300 for Joe, and 200 for Ben. That gives us a total of 900, representing all interest charged to all the receivables. We have discount allowed. We have 100 for Bennett, 80 for Joe, and 50 for Ben. That gives us a total of $230. Then we have dishonored checks. We have 100 for Bennett, 80 for Joe, and 50 for Ben. That gives us a total of $230. We have bad debt written off. We have 7 for Bennett, 5 for Joe, and 4 for Ben. That gives us a total of $16. Now, it is with this total that the organization will work with. Remember that we are preparing this account for Victory Enterprises. Now, knowing the total balance brought down for all the receivables, that is opening balance for the current month or current period, knowing the total sales, total cash receivable, total check received, total interest charge, total discount allowed, and total dishonored check, and total bad debt written off, it is now possible for the organization to prepare what is known as total receivable control account, or which can also be called the sales ledger control account. It is called the sales ledger control account because it is when we sell on credit that receivables results. So we are now expected to prepare for Victory Enterprises total receivable control account. Now let's see how it looks like. So the first thing we are bringing into the total receivable control account is balance brought down. At this point, we call it total receivable control account, representing all the receivables. We just have 3 here. Even if they were to be 500 receivables, it is in this same way that we are going to analyze them before we transfer them to the total receivable control account. The 6,000 opening balance brought down of 6,000, represents all the balance brought down for all the receivables. Then the next thing we take into consideration is sales. Remember we said that receivables has debit balances or debit balance. Therefore, we debit the opening balance of receivable control account in any receivable account. Then, what do we debit alongside? We debit alongside all the transactions that will increase the amount that receivables are owing. And one of the things we are going to debit alongside will be sales. Of course, this sales represents credit sales, which is $45,000. So, having added the total credit sales of $45,000 to $6,000, it means that the total receivables are owing at this point is $45,000 plus $6,000, which is about $51,000. Then we have cash received from receivables. Of course, they are owing us, so we receive from them. They could be check received, cash received, bills receivable, and so on. But for now, we have cash received. Total of cash received is $26,000. And of course, when we receive cash from receivables, it reduces the amount they are owing. And the law says any transaction that will reduce the amount they are owing should be what? Credited. So what do? The total cash received is $26,000 and the total check received is $1,200. So we credit these 2 transactions at this account because even the check received reduces the amount receivables are owing. So we have credited the cash received of $26,000 and check received of $1,200. From the table, the next thing we have is interest charge on customers. Any interest charge on customers increases the amount they are owing, and the total here is 900. Of course, we have to debit it, since all transactions that increases amount receivables are owing should be debited alongside the opening balance. So we bring this 900 to the debit side. So we have interest charge of 900 debited. The next thing we have here is discount allowed. When discounts are allowed on receivables, it decreases the amount they are owing and has to be credited. So the total discount allowed is $230. So we credit it to this account. Now the next thing we have is dishonored check, which is 230. When part of checks or all of the checks is dishonored, what we do is to debit it to the total receivable control account, because it goes back to increase the amount they are owing, because a check has been previously received of $1,200. Out of this check, they discovered that a total of $230 check has been dishonored from this $1,200. So what they do is to debit it back to the account to make sure that that amount is cancelled. So what do we do now? We debit the dishonored check to this account. So we debit dishonored check to the total receivable control account. The final transaction in this table is bad debt written off, and the total is $16. When bad debts are cancelled or written off for receivables, it reduces or decreases the amount they are owing and has to be what? Credited. Because some of the goods sold to them, there are many receivables that makes up this $45,000 credit sales. And Victory Enterprises discovers that some of them can never pay. So the best thing is to cancel it. And when they want to cancel it, it will be credited to this account as bad debt written off. And this reduces the total amount that receivables are owing. So what do? We credit bad debt written off to this account. So we credit bad debt written off of $16 to this account. So to balance the total receivable control account or the sales ledger control account, we add the debit side, which represents the total amount that receivables are owing directly or indirectly. That is 6,000 plus 45,000 plus 900 plus 230, which gives us 52,130. And we deduct from this amount the total amount that receivables has paid or we have received from them directly or indirectly. Therefore, we now have 52,130 minus 26,000 minus 1,200 minus 230 minus 16, and that should give us a balance carried down of 24,684. If you add 24,684 plus 16 plus 230 plus 1,200 plus 26,000, it's going to give you 52,130, which is now closed in the same line with the amount closed on the debit side. And finally, the closing balance of receivables, which is 24,684, is now brought back to the debit side under the closed figure of 52,130 and shown as a balance brought down for the next period. That is 24,684. Now, from what we have done now, we now have that the net amount that all the receivables are owing, or the total receivables are owing, is 24,684. That was used as the closing balance here. With this kind of account, the manager of the organization or the accountant will be able at a glance to know the total amount that receivables are owing. In the absence of this kind of account, and we have the individual receivables account up to 100, 200 or 300, or even in thousands, it will be very difficult for the senior staffs that are controlling this account to control what? Fraud. There will be fraud and all types of manipulation. But with the use of the total receivable control account, the total receivable balance at the end of the period can be known at a glance, 24,684. And with this, a great form of control is exercised over the individual control account. Now you have just received the foundation knowledge in the preparation of total receivable control account. In our next lecture, we are going to take a more comprehensive question, bringing into consideration plenty transactions, so that your knowledge in the preparation of the total receivable control account will be widened.